Bitcoin and tax. A lot of people think one of the main benefits to crypto is being able to hide your wealth away from the man in the unregulated or deregulated cryptocurrency platforms. Unfortunately, that's not really how it works. In this episode, I'm going to walk you through the various different trigger points for capital gain tax in the cryptocurrency space, what that looks like, and the things that you need to know before you start to move, transfer, or sell your cryptocurrency, and also give you a little bit of a bonus feature if you wait till the very end about ways that you can really minimize the tax for the intended use that cryptocurrency had. I'm Jeremy Iannuzzelli, and welcome to What School Should Have Taught You. This is a podcast where I share with you all the lessons you need to know about building true wealth.
Everything school should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Jeremy Iannuzzelli will be sharing his lessons on everything school should have taught you so you can build the life you want.
Bitcoin is one of these things that has been absolutely exploding over the last 10 years, or cryptocurrency in general. A lot of my clients have gone into the cryptocurrency space as a form of wealth creation, investing their money in various different cryptocurrency platforms and cryptocurrency coins. Now, it's really understanding the tax implications involved when you start to invest your money in this deregulated or decentralized space. The Australian Tax Office has spent a large amount of time and a large amount of money investing in the resources that they need to capture when clients are taking money in and out of various platforms or moving their cryptocurrency into various different coins. We need to understand the various different trigger points for tax and what that looks like. So I want to give you a very easy example to start with. If you've invested your first $10,000 into Bitcoin, for argument's sake, is what many people do, and that Bitcoin has now gone up to $20,000, there's no capital gain event that has occurred because you haven't triggered a sale or a transfer. But for argument's sake, if you decide then to move that $20,000 worth of cryptocurrency held in Bitcoin to Ethereum, all of a sudden you're now selling out of Bitcoin and moving your $20,000 to Ethereum. Therefore, you've now crystallized that $10,000 gain that's been made. Because if you remember, we started with $10,000 as an initial purchase price into Bitcoin, and then that's gone up to now $20,000. And we've now moved that cryptocurrency position being $20,000 in Bitcoin to now $20,000 in Ethereum. Essentially, now you've made a $10,000 capital gain. Now, the timing of when that happens becomes very important because it could be within 12 months, which means you've now made a gross gain of $10,000, which you now need to pay capital gain tax on. Or if it's happened after a period of 12 months, you will be eligible for a capital gains discount, which is 50% depending on the entity that you've invested in, say for instance, your own name or a trust. If you've invested that money via a company, then there would be no capital gain tax exemption and you'd be paying tax at the rate of the company. So it's important to understand that when you're putting money into a platform, buying a specific cryptocurrency, then transferring that to a different coin, you've essentially triggered a sale and capital gain tax is applicable. If you've just left that money inside the cryptocurrency coin itself and it's grown, it will not trigger a capital gain event until it's sold. So there are a couple of the little things that you need to note of. The Australian Taxation Office has become very intuitive, linking themselves as a service with many of the cryptocurrency platforms. So they're actually notifying accountants of when a cryptocurrency transaction has occurred. And as an accountant, we're now supposed to really talk to our clients about what's happened with your various cryptocurrency investments. Have you sold it? Have you transferred it? Have you taken it out of the platform? Have you left it with inside the same cryptocurrency coin? Have you now moved it to a different platform, say a different platform overseas? We need to know about this as accountants so we can assist you in minimizing the amount of tax that you're paying. Again, if you've got various different things happening, such as trading activities, a lot of people, and I've got clients who have invested into bots, and these bots are buying and selling various different cryptocurrencies on a daily basis, probably in the range of hundreds, if not thousands of transactions. You really need to classify yourself as either an investor or a trader. And these investment or trading activities will determine what tax you're going to pay. If you're holding cryptocurrency as an investor, similar to that of a share investor, you'll pay capital gains tax when you sell or transfer the cryptocurrency. If you're trading cryptocurrency, then tax is generally based on a revenue basis, meaning you pay tax on the profit at the marginal rate of the investor. So it's very important to identify whether you are an investor holding for the longer term or you're a trader really trying to generate a daily revenue from your cryptocurrency transactions. The difference of interpretation between an investor and a trader could be significant amounts of tax paid versus significant amounts of tax saved. So there's a huge difference there in terms of the classification of if you are a cryptocurrency investor or a cryptocurrency trader. One of the little known things out there for cryptocurrency enthusiasts. Now, I myself have my own reservations about cryptocurrency due to the fact of my lack of knowledge around the investment itself. But if you're using cryptocurrency as it was intended to be used for, which is a genuine currency for trading in goods and services, for argument's sake, if you've invested $10,000 into the cryptocurrency platform, as Bitcoin being your vice or chosen cryptocurrency coin, and that Bitcoin seems to go up to, say, $50,000. So we've had a $40,000 growth in terms of the original $10,000 that you invested. The ATO has made allowances if you're truly using the cryptocurrency coin as a method or means for paying for goods and services. If you're paying for goods and services, for argument's sake, you've got someone that's come in to do some work at your home and you've paid them $5,000 in cryptocurrency, then it's not seen as a gain because you're using the currency movement to pay for goods and services. There is a threshold that the tax office has made an allowance for, and that's a threshold of $10,000. So if you're buying goods or services to the value of $10,000 or less, there's no gain that's been made on the growth of your cryptocurrency because you're using the currency for what it was intended to be, which was a store of wealth to be used for goods and services or a means or method of transaction for goods and services. If you're using cryptocurrency very much like an equity, a share, managed fund, a property, which is a means of creating wealth through investing in this particular store of wealth or investing in this particular cryptocurrency, then you will be taxed as a normal investor. So it's important to understand, are you an investor? Are you a trader? Or are you simply using cryptocurrency as a means for payment for goods and services? Understanding who you are in those three different parts of utilizing cryptocurrency means the difference of paying no tax, some tax, or a lot of tax, depending on the wealth that's been made utilizing, say, Bitcoin, Ethereum, or various cryptocurrency coins. It's important to understand that the ATO is spending lots of money and lots of time understanding the movements of cryptocurrency investors. Again, if you're one of those people that have been reading about investing in X and pulling out in Y, investing in country A, pulling out in country B, there are means and methods that you will be found trying to avoid or dodge the tax man, especially here in Australia. So my words of wisdom would always be play with a straight bat, understand the way that you're going to be transacting with cryptocurrency, whether it's a mean or method for paying for goods and services to the value of $10,000 or less. Whether you're an investor trying to hold cryptocurrency for the long term to create wealth, or whether you're a cryptocurrency trader utilizing your own skills or bots to have hundreds or thousands of trades going on a daily basis to create a revenue stream, you just need to make sure that you structure yourself accordingly. Whether you use corporate structuring such as companies or trusts, or you do it in your own name, there will be tax implications involved. Don't forget to click the link below or subscribe. And if you have some questions, please leave it in the comment sections below. Don't forget, click the show bio link. And if you've got questions, we may be able to get you here on this show, and hopefully I can answer them for you. I'm Jeremy Iannuzzelli, and this is what school should have taught you.